Good afternoon, everybody. I'm Carolyn Aver. I'm your CFO. We announced our results for both Q4 and 2013 this afternoon, and I'd like to take a few minutes to review them with you. So how did we do in 2013? Well, from my perspective, pretty good. While revenue was down from 2012, we improved our gross margins significantly, as we all know was a big goal of ours for the year. And in fact, if you look at gross margin dollars, our gross margin dollars were virtually flat year over year. So quite a good improvement and focus on gross margin, and thank you for all of that. We managed our operating expenses while investing on important areas for the future, and we generated over $54 million of cash from operations. We bought back 18 million shares and increased our stock price by 40% for the year. Not bad, I'd say. Now, when I met with you all in January of 2013, I laid out some goals. And really, we knew that revenue was going to be a challenge for us in 2013. So what we said is, let's just be sure we outperform the market. And I think we can tell from the reports that Peter sends out, in all the places we've gotten #1 market share this year, we know we've done just that. We said focus on gross margins. And if you look at the numbers I just showed you, we know we did just that. And do those things while we invest in the next big growth cycles. And as we've been seeing presentations over the course of the year from the Edge team and from Krish and Tom and the work they've been doing in UVP, we can see we've made amazing strides preparing us for these next big growth cycles. And we wanted to align our incentives around those themes, and I think we did that as well. So as we sit here today, we are incredibly well positioned to take advantage of the next waves of growth that we see beginning both in 2014 and beyond. Now let's take a look at the quarter and see how we did. We did $120.2 million in revenue, just $1 million shy of where consensus is, and right in the middle of the guidance range. We did 54% gross margins, fabulous quarter on gross margins, beat street consensus of 51.5%. Our guidance was 51 to 52, and we significantly outperformed that. How did we do that? Really in 3 ways. First, every one of our product lines had higher gross margins in Q4 than they did in Q3. So across the board, good work. Second, we continue to deliver a high amount of software. That drives gross margin. It's part of that razor blade strategy that we have. And so we've been able to sell incremental licenses both in the video processing products and in the Edge products. And we've even sold some early technology on the UVP side. So great quarter in selling software. And then lastly, the Edge business itself, whose margins we expected to come down in Q4 because we actually took revenue on our first multi-million-dollar order for the NSG Pro. But they did such a great job of managing their gross margins across their whole product line that they actually outperformed our targets and really helped drive this quite positive surprise on gross margins. So great job, everybody, and good work in the quarter focusing on the gross margins. Now, on the operating expense side, we spent $54.5 million. Our guidance was $53 to $54 million. The street's expecting $53.5. So we overspent a bit this quarter. And when we get to talking about Q1, we're going to talk about how important it is to manage our expenses and hit that expense model. Our operating income was $10.7 million in the quarter, about 9%, and that generated 8 cents a share, beat the street by a penny. Now, when you look at that in contrast to the same quarter last year, you'll see we had revenue growth of 2%. Gross margins roughly the same, operating expenses roughly the same, operating income roughly the same, but we generated a penny more a share because we had the benefit of all the shares we bought back over the course of the year. And that allows us to improve our earnings per share even on relatively flat income. Now let's look at how we did a little bit more in detail on the revenue side. 60% of our revenue in Q4 came from international. The EMEA market has been very strong for us all quarter. They had a solid performance this year, and they continue to have a very solid performance in Q4. Emerging markets have definitely been one of our big growth drivers, and Q4 was no different there, led by Asia Pacific this quarter and a nice quarter in revenue from the Latin America team as well. As I look at products, I can say that the star performer of products in Q4 was our MediaGrid product. We had record revenues from MediaGrid. That led a nice, strong performance from production and playout. The Edge business recovered in the second half of the year, and we had nice growth in the second half from Edge over the first half. And then video products continues to be a strong base of revenue for us. And both for the year and for the quarter, we saw some nice growth from the service business, which was our strongest growing business line year over year. Lastly, when we take a look at the market segments, we know that broadcast and media has been what's really driven growth this whole fiscal year, and there too, Q4 was no exception. 42% of our revenue now comes from broadcast and media. The cable business, again, with a good recovery, had 35% of revenue. And we even saw growth in satellite and telco in Q4 with a nice order coming in from telco on the new software platform. So very strong performance there in all markets. When we look at the balance sheet, we can see that we had a good quarter in cash. We ended the quarter with $170 million in cash, about $1 million up from the prior quarter. Maybe that doesn't sound so good until you realize we spent $13 million to buy back stock in the quarter and $7.5 million to do a deposit on inventory. So we actually generated over $18 million of cash from operations again. We did that by continuing to really drive our day sales outstanding from an accounts receivable perspective, and those were 57 days now compared to 63 days last quarter. For the last 2 quarters, we've had very good inventory management. We've been able to deliver 6 turns for each of the last 2 quarters. We're managing our capital expenditures to just around $3 million a quarter, and as I just mentioned, we repurchased 1.8 million shares this quarter for $13 million. So again, our balance sheet, very solid, very good execution from that side. Looking forward to Q1, we always expect Q1 to be sequentially down, although certainly up on a year-over-year basis, and this quarter's no different. Q1 is always a challenge. We spend a lot of time at sales kickoff. We get quotas set. We're rolling out new programs. But we need everybody to really focus now and make sure we drive a really good start to the year and a really good Q1 revenue performance. As you can see, we expect our gross margins to be somewhat down this quarter compared to last quarter. And that's because we got a second multi-million-dollar order for the NSG Pro. So this will be our biggest quarter of NSG Pro shipments that we've had to date. And as we've talked about, those first units that we're shipping for the NSG Pro come at a low margin because we haven't gotten all the efficiencies out of the manufacturing processes yet. So this will be a one-time event where we have lower margins on the NSG Pro. We expect to ship more revenue this quarter on the Pro, and therefore that will take our margins down just this quarter. Next quarter, that'll recover and move back up again. On the operating expense side, our budget is to do $54 million in operating expenses this quarter, and we all need to work to hit that number. It's our target. We don't want to be over target this quarter, so I'm asking all of you to really focus on cost containment, make sure we hit that goal. Again, our tax rate stays at 21%. If we do all of those things, I think we'll get off to a quick start to the year, have some good results, drive into growth as we move through the year, and see another great result with stock price this year as we did last year. So in summary, I want to say thanks for all the hard work in 2013. We certainly set ourselves up to have an amazing 2014. Big job in Q1. We want to get off to a quick start. Let's all work together and have a great year. Thanks again.